Hello, everyone. This is Bart Kohler. Thank you for joining me. In this slide presentation today, we're going to learn about cryptocurrencies and Team Five's task at evaluating a FinTech blockchain startup or an existing company that decided to venture into the cryptocurrency or blockchain market. So, what is blockchain? Well, blockchain is a ledger system. It's an open ledger system, peer to peer network with no central authority. It is a great, secure way of keeping transactions and information. It's completely secure with an algorithmic code that secures and connects blocks of records. The infrastructure on which cryptocurrencies like Bitcoin and others are built on the blockchain. So think of it as the blockchain as the rail and cryptocurrency as the train. Cryptocurrency definition: cryptocurrency is a digital currency that is used building blockchain technology. It's stored on the peer to peer network and it's verified by using the algorithmic code or the secret set of keys. Very secure. It has no central authority. So we've heard a lot about cryptocurrency and what's been happening. A lot of people have heard about Bitcoin and things that are happening in the news with new coins coming out. And so there's a lot of information that is being reported. And currently, there are scores of companies that are coming up with the idea that, hey, we can get into this blockchain uh, technology and we can raise the values of our stock because there's a lot of interest in this whole topic. So, with scores of companies out there introducing cryptocurrencies and blockchain technologies, the SEC has stepped in to limit the damage that you have and some of the consumer confidence issues that we have surrounding these new technologies. So it's been in the news, and it's something that's been very interesting to watch. So we're going to take a look at the issues that we have today. So how do we determine something that is a new startup or something that is a new venture? And it's difficult to do in evaluating a business like this because in many cases they don't have any deep financial data for investors and firms that consult investors to look at. So we want to look at a few key factors in determining the value or the legitimacy of these cryptocurrency or blockchain inventions. So we look at the investors, we look at who they are and their backgrounds. We can look at the self investment of the parent company or the venture capital that they've secured. And then finally, the big shadow that overlooms and hangs over all of this great innovative technology is regulation. What will government do with it? How will they shape positively or negatively these new technologies? So all these things were things that Group 5 had to consider. So determining whether it was just hype or if it was actually ripe with opportunity is something that was their challenge. So, does it actually solve a problem in the marketplace? How long will it last? What will the regulators do? All these ideas and questions come into play for these people that are tasked with evaluating these new technologies. So in the cases that we looked at, we had the Kodak coin, which is a crypto coin product that was designed to pay photographers for image rights that were being used on the internet. So that was one of the ideas that they came up with, along with a mining device. Long Blockchain, which was the Long Island Iced Tea company, simply changed its name and announced plans to mine Bitcoin, and their stocks rose exponentially. Without any real value or any real solution to a problem, they ran into some problems with NASDAQ delisting the stock and actually a subpoena from the SEC. So Team Five took this case and they kind of laid them out side by side, and they looked at some of the elements of good actors and some of the elements of bad actors. And what they came up with were the investors, the parent company, the risk, the problem or the solution that was being solved, the solution that was being created to solve a potential problem in the market. And then the bad actors, we had signs of abuse or skeptical track records. The company itself wasn't really willing to invest a great degree of money into these new technologies and into the venture, and they really didn't seem to solve any type of a problem. So uh, they had these side by side, but their job was really to come up with a solution to not just look at these cases, but other cases. So Team 5 comes up with hyper ripe startup scorecard. So they decide to come up with a method and a scoring system to risk the level of any given company's blockchain or cryptocurrency venture. And by listing a set of factors that were non financial or semi financial categories, they can score them from 1 to 5 and come up with a single number that would help push them in the right direction and help them guide investors. So the method allowed them to start with the categories themselves. Of course, they would look at any financial data that they could gather, but business start date could tell a lot about if the idea had been something that had been seasoned a little bit, or if it's something that a company had just introduced. We had the product idea itself, the leadership, how the product related to the existing business, the business model, the parent company, all of these factors, future applications, what the incumbents and competition were doing, the disruption level possibilities of the new technology, all seem to be non-financial factors that they could look at. The semi-financial categories were current regulation cost, if any, application cost, possibly intellectual property value, the investment level of the parent company, were they putting a lot of money in it? The venture capital agreements, if they had any in place, what were those going to be, and what involved in those transactions and agreements, and the ownership structure. All very important factors for them to look at. So as they laid this out, we scored them. The team scores them from 1 to 5, say, and we come up with Kodak and Long Island. Kodak with 51 out of a possible 80, and Long Island blockchain or Long blockchain a possible 27 out of 80. So the team quickly can recognize the value or the non-value of a given product. So in these cases, we see that the Kodak product actually had some merit and had some future value, maybe surrounding the right leadership and marketing campaign. That this product could have been something great and may still be someday. So, without hindsight, as being a 2020 here, the team would say that it had potential and invest, but it's still high risk. And of course, the blockchain company, Long Blockchain, Long Island Iced Tea Company, scoring 27 out of 80. There was a lot of problems that the team identified with that group. So uh, when we look at the final conclusion for the team clearly saw the risk factors uh, by a numerical value with their hype or ripe scorecard system. And the risk factor for the Kodak coin venture were nearly double, but both were risky, obviously. And now they did have a tool that could more easily measure these new companies that had limited data to go on. This way, their firm could more confidently offer something to their investors in the form of a recommendation for investment. So, very exciting to see how things like this can play out. Thank you very much for watching this presentation. I hope you learned something about blockchain, cryptocurrency, and how to evaluate and determine some of these ventures that can come up. Thank you very much. I'm Bart Kohler.